2 years ago, a gold miner earned about $600 of profit on every ounce it pulled out of the ground. Today, at roughly the same cost, it earns around $2,500. Gold doubled, but miner profit per ounce went up almost 5 times. That's operating leverage, and it's the most violent profit engine in commodities. Gold sits near $4,000 an ounce after touching an all-time high above $5,500 in January 2026. Central banks bought 863 tons last year, and the mining stocks, which lagged the metal for a decade, finally exploded, up 154% in 2025, while gold rose 80%. Let's get into who's actually printing the money. First, why is gold here at all? This isn't your grandfather's inflation hedge story. It's something bigger. Central banks are in an arms race. They bought 863 tons of gold in 2025, the 4th largest haul ever, roughly double the historical norm, led by Poland, China, and emerging markets. They're not buying for safety. They're buying because they no longer fully trust each other's currencies, especially the dollar. That's the first re-monetization of gold since the end of Bretton Woods. Add a record $89 billion of ETF inflows in 2025, and you have a demand wall that has almost nothing to do with jewelry or inflation. It's about trust in paper money, and that trust is eroding. Now, the math that makes mining stocks so explosive and so dangerous. A miner's costs are mostly fixed. The industry all-in sustaining cost, the true cost to dig an ounce, sits around $1,600 and barely moves year to year. So when gold goes from $2,000 to $4,000, almost the entire increase drops to the bottom line. Watch the gap. Gold's price rose about 114% off its 2023 base. Miner margins per ounce rose over 300%. That's why a 30% move in gold can double a miner's earnings, and why a 30% drop can erase them. Leverage cuts both ways. Here's the puzzle that frustrated gold investors for years. The metal kept hitting records, and the miners did nothing. Diesel costs, labor inflation, mine disasters, and terrible capital allocation ate every gain. So investors gave up on the miners and just bought the metal. Then, 2025 happened. The gold mining index jumped 154%, nearly twice gold's 80% gain, as costs finally stabilized and the margin expansion became impossible to ignore. The decade-long gap between the metal and the men who dig it is now closing fast. The question is whether there's more to go or whether you've already missed it. Let's put the field on the board. There are 2 ways to own this boom. The operators, who actually dig, Newmont, the $130 billion world number 1, Barrick, number 2, now trading under the ticker B, Agnico Eagle, the safe jurisdiction premium name, and Kinross, the mid-tier producer. Then the financiers who never touch a mine, Franco-Nevada and Wheaton, the royalty and streaming companies. If you're following this series on the commodities and machines behind the global economy, subscribe. Next up, the diabetes tech companies turning a glucose sensor into one of the fastest-growing markets in healthcare. Same depth. Start with the king, Newmont, the largest gold miner on Earth at $130 billion market cap. It did $7.3 billion in revenue in a single quarter, and here's its real weapon. An all-in sustaining cost of just $1,029 an ounce, the lowest among the majors. At $4,000 gold, that's nearly $3,000 of margin on every ounce. After swallowing Newcrest for $17 billion and selling off its weaker mines, Newmont is now a leaner, lower-cost machine pointed straight at the highest gold prices in history. Its first quarter of 2026 generated $3.1 billion in free cash flow, an all-time quarterly record. When the biggest lowest-cost producer meets a record price, the cash flow becomes almost absurd. Barrick, recently renamed and now trading under the single-letter ticker B, is the number 2 producer at a $91 billion market cap. It did $5.2 billion in quarterly revenue, but its all-in sustaining cost runs much higher, around $1,700. So it has less margin cushion than Newmont. Its wild card is copper. Roughly 13% of revenue comes from the red metal, which ties it to the electrification boom as well as gold. That's a double-edged identity. In a gold spike, Barrick captures less per ounce than Newmont, but its copper gives it a second engine that the pure gold names simply don't have. Agnico Eagle is the one that trades at a premium to the whole group, and there's a clear reason. It mines almost entirely in safe, stable jurisdictions. Canada, Finland, Australia. No coups, no sudden nationalizations, no mines seized by a hostile government. $4.1 billion in quarterly revenue, costs around $1,483 an ounce, and a market cap near $110 billion, closing in on Barrick despite producing less gold. That's the lesson institutional money learned the hard way. In mining, where your gold sits in the ground, matters as much as how much you have. Investors will pay up to never wake up to a headline that a government just took the mine. Geology is destiny, but geography is the premium. Now, the most elegant business model in the entire sector, and my favorite counterintuitive fact. Franco-Nevada earns a 91% earnings margin without ever touching a mine, hiring a geologist, or worrying about the price of diesel. How? It's a royalty and streaming company. It hands miners cash up front to build a mine, and in return takes a slice of the gold forever at a fixed low price. So when costs explode at the operators, Franco-Nevada doesn't care. Its cost is locked. When gold rises, it captures the upside with none of the operating risk. Wheaton Precious Metals runs the same model across gold and silver. They are, in effect, the banks of the gold industry, and they sleep better than anyone who owns a shovel. One more operator and one industry-wide signal worth understanding. Kinross is the mid-tier producer. $2.4 billion in quarterly revenue, costs around $1,700 an ounce, a $30 billion company. It's a higher cost, higher leverage way to play the same gold price. More torque if bullion keeps rising, more pain if it falls. And across the whole sector, the cash is triggering a feeding frenzy. Mining mergers and acquisitions hit $139 billion. An 18-year high. When miners have this much cash and not enough new deposits, they buy each other. That consolidation wave is itself a reason the quality names keep re-rating. Now the honest column, because gold giveth and gold taketh away. First and biggest, the gold price itself. Everything here is operating leverage on one number. Gold is already down about 5% from its January peak, and if it falls hard, miner earnings fall harder. Second, cost inflation. The moment labor and energy costs start climbing again, that beautiful margin expansion reverses. Third, jurisdiction risk. Taxes, permits, and outright seizure in the wrong country. Fourth, depletion. Every ounce mined must be replaced, and new discoveries are getting rarer and lower grade. So the debate isn't whether miners are minting money today, they are. It's whether $4,000 gold holds, and whether they keep their costs down when it does. Where does this go over the next 1 to 2 years? Base case. If gold holds near current levels, the majors throw off record-free cash flow, raise dividends, and keep buying each other. Probable, not guaranteed, and entirely dependent on the metal. 3 things to track. 1. Central bank buying. Watch the World Gold Council's quarterly tonnage. If it stays above 500 tons a year, the structural bid holds. 2. All-in sustaining costs. Watch whether the majors keep costs near 1,600 or let inflation creep back. That's the margin. 3. The gold mining index versus gold gap. If the miners keep outpacing the metal, the re-rating still has room. Catalysts up. Fed rate cuts, more central bank buying, and continued de-dollarization. Catalysts down. A gold price reversal, a cost spike, or a risk-on rotation out of safe havens. Upstream sits the dwindling supply of new deposits. Downstream sit the central banks and ETFs absorbing the metal. The miners in the middle turn the price into cash. For a decade, owning gold beat owning the people who dig it. That just flipped. Costs stopped rising, the price went vertical, and the most extreme operating leverage in commodities finally worked in the miners' favor. The catch is simple. It all rides on one number. If gold holds, these are cash machines. If it cracks, the leverage runs in reverse. I'm Big Z. Follow me. See you in the next deep dive.